But one of the things that COMEX can do if they find the price is rising too fast, and rising too fast would mean the shorts are getting in trouble, and trust me, the shorts probably are in trouble at the moment because they're having to meet margin calls. The margin on COMEX futures was silver futures was 22,000. I'm telling you that on Monday they're going to raise that margin. I think on Monday it's very likely we will see an increase in the margin requirement from $22,000 to $25,000. Just my guess, it could be another number. And that will bring out a small number of forced sellers, which would, in normal times, bring down the price.
The silver market is entering a moment of acute stress, and the warning signs are no longer subtle. According to Clive Thompson, one of the clearest signals of instability is not price alone, but the response of the futures market infrastructure itself. When prices begin to rise too quickly, it is not enthusiasm that concerns the exchanges, it is leverage. Rapid price acceleration forces short positions into margin stress, and Thompson makes it clear that this pressure is already building beneath the surface. Margin requirements on COMEX silver futures currently stand at $22,000 per contract, but based on current volatility and positioning, Thompson believes an increase is not only possible, but highly likely as early as Monday. Thompson's concern is rooted in how exchanges historically respond to disorderly price action. Margin hikes are not neutral events. They are blunt tools designed to slow markets by forcing participants to post more capital immediately. In this case, a move from $22,000 to roughly $25,000 per contract would represent a meaningful tightening of financial conditions for leveraged traders. That increase may sound modest in isolation, but in a market where contracts represent 5,000 ounces of silver, the capital burden rises fast. Thompson's warning is clear. Margin pressure has the potential to trigger forced selling, not because market participants want to exit positions, but because they are compelled to do so. In this video, we will walk through Thompson's most important warnings, the data underpinning them, and what they could mean for silver prices as early as tomorrow. If you like clear, actionable analysis and insightful deep dives, please like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
So on COMEX, the open interest at the moment is 150,000 contracts of silver. So each contract is 5,000 ounces. So 150,000 contracts of 5,000 is 750 million ounces of open contracts. But the amount of registered silver, that's the silver which can be delivered, is only 113 million ounces. So we got contracts of 750 million. That's to say people have bought 750 million ounces of silver for future delivery on COMEX, but the amount available to be delivered is only 113 million. Now, in normal times, you'd say there's nothing to worry about particularly, except that this 113 million ounces is way down from the figure it was 5 years ago. So the deliverable silver has been going down, and presumably the number of open, I don't have the figure on the number of open contracts, but presumably the number of open contracts has been going up. Now, it's no problem if only 1 in 8 of these contracts ask for delivery. If they do, basically they'll absorb all of the silver in COMEX and there won't be anything left. Realistically speaking, people roll over their contracts. So they bought silver, it comes to maturity, they roll it over to a future date and keep rolling and rolling and rolling. But we've seen a very unusual spike in the last year of people actually demanding delivery of the silver they bought on the future market. So in the event that this 750 million of contracts which have been, of ounces of contract which have been bought, asked for delivery, well, there's only 113 million which can be delivered. There isn't enough for everybody. So that could be a concern for the major silver consumers. The biggest silver consumers is the solar industry, the solar panel industry. They're consuming about just under 30% of all of the production of silver. And these are companies like First Solar, Jinko Silver, Longi Green, Canadian Solar, Trina Solar, those sort of companies. They collectively consuming 30% of all the silver which is produced. And why is it a concern for them? Well, if they can't get their hands on the silver, production stops. Bam. So whilst they're sensitive to the price of silver, they're far more sensitive to a cut in production. The next biggest consumer of silver is the technology industry. This would be companies like Samsung, Apple, Nvidia, Intel, Microsoft, and so forth. Collectively, they are consuming, I don't have the figure, but it's probably about 15% of the silver, of the silver production. That's actually, I've got that figure. Yes, it's between 12 and 15% of all production is going in their direction. The risk for these companies, if they can't get their hands on silver, is high to critical. Critical basically means they can't make things if they can't get the silver. The other consumer of silver are the car companies. These are companies like Tesla, BYD, Volkswagen, General Motors, and Ford. Collectively, not collectively, each of them is producing something, needs something like 500,000 to 5 million ounces of silver a year for their car production. The amount of silver in a car is somewhere between 0.8 ounces and 1.6 ounces. So the silver price is not a critical component of the manufacturing cost. If the silver price goes from $30 to $100, that increases the cost of your car by $70. So if you've got a $50,000 car, only 30, that was the old price of silver, dollars of that. Now the new price of silver is $100, let's say. I mean, it's not quite there yet. The rising price of silver doesn't affect the price of the car very much, but if the car manufacturer can't get his hands on the silver, the entire production line stops. So with this physical shortage we're seeing in the marketplace, there must be some major worries from the consumers of silver who are saying, my God, we've been running what's called just-in-time supply chain. In other words, we get our silver just in time. We maybe keep 2 to 4 weeks supply, which is kind of just in time, but actually we now can't get we've just used a week's worth of that supply. We can't get the new week because the silver isn't there. We can't find it. Every major company which needs to use silver in its every company, let's say, who needs silver in its manufacturing process must be now starting to, I don't want to use the word panic, but in a rush to make sure they're going to be able to lay their hands on the silver that they absolutely have to keep the production going. So what will they be doing? They'll be going out and looking to see where they can borrow it and at what price. They'll be looking to see if they can maybe secure an agreement with a mining company to guarantee the delivery of silver on an ongoing basis. Maybe they'll say we don't need 3 weeks supply of silver. We need to have 6 or 8 or 10 weeks of supply of silver in storage just in case we can't get our hands on silver. So there's a bit of a problem there. Just to put these numbers in perspective, I'll give you the full annual mined production. So the annual mined production for 2025 is estimated at 985 million ounces, and the demand in 2025 is estimated at 1,102 million ounces. So that's a shortage of 117 million ounces. Of that demand, they are estimating that 200 to 260 million ounces were going into the hands of investors. In other words, people buying silver. I rather think that with the way things are going, a lot more is going to go into the hands of investors in the coming year. Exchange traded funds, they hold 853 million ounces. That's less than a year's supply of silver. Those are the major ETFs. If I take all of the ETFs, it's probably about 1 billion ounces, roughly, which is roughly equal to the annual, or just a little bit less than the annual demand. So there is some above ground supply. If investors start selling their ETFs, that supply will be available to meet the demand. But obviously investors are only going to sell their ETFs if they can get a high enough price to satisfy themselves.
While margin policy may dictate short-term volatility, Thompson argues that the real fault line in the silver market lies in the widening disconnect between paper claims and physical availability. Futures markets can absorb leverage only as long as confidence remains intact, but confidence depends on the assumption that delivery is largely theoretical. When that assumption weakens, pricing mechanisms begin to behave very differently. This is where Thompson shifts from short-term mechanics to structural risk, and why his broader analysis deserves close attention. To understand why margin stress and price volatility are occurring at the same time, we need to look closely at how much silver actually exists to meet contractual demand. Let's get back to Clive Thompson's video.
Now, we've got this gap between Shanghai prices and New York prices over the Christmas period. I'm always a bit wary about prices around Christmas time and the gap between Christmas and New Year, because that's the sort of time when all the senior people in the big firms and the big trading firms go on holiday. So you might have a floor of 50 traders or 100 traders, and they leave behind a skeleton staff of 5, 10, 15 staff. But the staff who are left behind are the ones who draw the short straw. The short straw are the junior traders, the new boys, and they will be left with very, very strict instructions. Do not trade, or don't open any positions, or this is your limit. So they're just basically there to man the phones and take orders from the clients and do what they're told, and hopefully not make any mistakes with the fat thumb buying 1,000 contracts instead of one contract. This sort of thing might happen. But what that does mean is that because there's so few traders there, and because they're not the more senior traders, they're not authorized to take positions which can smooth out market movements. So we can, between Christmas and New Year and just before Christmas, have some very large movements which won't be smoothed out because they're not authorized to smooth them out. So in normal times, if a trader comes in and buys 1,000 contracts or something, the big bank can take an equal and opposite position and arbitrage it away, smoothing out the price change, so the price of silver moves by 1 cent, 2 cents, 3 cents. But in these narrow times, a single large order might move the price of silver by 25 cents or 50 cents. So that's why I'm wary of the prices I see around Christmas and New Year. It doesn't mean to say that come New Year, when all the big boys are back in the office and the office is fully staffed and now they can take big positions, they don't start to smooth out the price movement. So we have seen very violent movements in the price of silver this period, which is kind of something which can happen in thin markets. And we are definitely in a thin market at the moment. Will we see a smoothing down of the price as we go into the new year or not? But now we're between Christmas and New Year. This is the thinnest period. So we might see some very violent moves on Monday. For all I know, we might go to $100. I'm not I'm not predicting that, and this is not investment advice. I'm just saying it is a possibility. But big swings are entirely possible in both directions, because it depends if some big trader comes in to do a sell as well. That's entirely possible. Although who in their right mind would be selling when everybody's trying to get their hands on silver when there isn't any? But there's obviously some people out there who just look at price and say, "Oh, it's more than I paid. I'll try and take my profit off the table immediately." It's not necessarily a great move at this time of year, because you might not get the price you wanted to do if you wanted to do that. Yes, margin. Will we go limit up on Monday? Now, limit up would be something like $10 on the price. So that would mean the price going from something like $77 to $87, which is not far off the closing Shanghai price. What was that? That was 70, $85, wasn't it? I forget now. Yeah, $85 in Shanghai. So going from 77 to 87 is entirely possible, given the Shanghai price is already 85, and that gap could close very quickly, especially if the Shanghai price continues upwards on Monday. But COMEX has got a strategy to stop the price rising too far. And when I use the word limit up, I want to stress there is no such thing as limit up anymore. It's a bit of a myth. We used to have what's called limit up in the old days, but what they have is, and I'm looking for the words here, it's some sort of price dynamic circuit breaker. That's it. So the dynamic circuit breaker kicks in if the price moves more than 10% from the lowest point in the last 10 minutes, I think it is. So if the last hour, actually, so if it moves more than 10% from the price in the last hour, then they have a circuit breaker, dynamic circuit breaker, where they stop trading, but they only stop trading for 2 minutes, only 2 minutes to allow traders to adjust their positions, and then it restarts with a new high and low. So any price change which is more than 10% from the previous high down, or more than 10% from the previous low up, will create another circuit breaker. So you could get multiple circuit breakers, but those circuit breakers are only 2 minutes each, and trading should continue. But one of the things that COMEX can do, if they find the price is rising too fast, and rising too fast would mean the shorts are getting in trouble, and trust me, the shorts probably are in trouble at the moment because they're having to meet margin calls. The margin on COMEX futures was, silver futures was 22,000. I'm telling you that on Monday, they're going to raise that margin. It will go up. So I'm guessing they're going to put it up to $25,000 per contract. Now, at $100, a contract would be worth, what would it be worth? $500,000. Yeah, you've got 5,000 ounces multiplied by 100. That would be $500,000. If they put the margin up to $25,000, that means for every $500,000 you trade, you've got to have $25,000 of cash or treasury bills with COMEX as basically security. Put another way, you can trade 20 times your equity. You will be able to at that level. Obviously, that's a very leveraged position, and they might, if the markets start moving even faster than we've seen, go higher than $25,000 as a margin on silver. But what happens when you increase margin? Well, there are some people who can't come up with the extra cash, because you've got to come up with the extra cash straight away, the same day. And if you can't come up with the extra cash, you only have one choice left, and that is to reduce your position or completely unwind it. So by putting up the margin, that brings out forced sellers, not because they want to sell. I mean, if they got a futures contract and they're long, they're obviously expecting the price to rise, but they have no choice. So I think on Monday, it's very likely we will see an increase in the margin requirement from $22,000 to $25,000. Just my guess, it could be another number. And that will bring out a small number of forced sellers, which would, in normal times, bring down the price. But we don't know that will happen because there's a huge interest in silver. We've got this physical shortage going on, which actually might mean that even though there'll be net selling from the futures, people are long futures, the silver price could still keep going up.
Thompson highlights a stark imbalance at the heart of the COMEX silver market. Open interest currently represents roughly 750 million ounces of silver, while registered inventories available for delivery cite near 113 million ounces. Under normal circumstances, this disparity is tolerated because most contracts are rolled forward rather than settled physically. However, Thompson points out that this norm is beginning to break down. Over the past year, an unusually high number of participants have opted to take delivery, steadily draining registered inventories and reducing the buffer that makes the system function smoothly. This tightening physical availability matters because silver is not a marginal input for the global economy. Thompson emphasizes that industrial demand is both large and inelastic. The solar sector alone consumes nearly 30% of global silver production, while technology firms account for another 12 to 15%. Automotive manufacturers, despite using relatively small amounts per vehicle, depend on consistent access to silver to keep production lines running. Price increases are manageable for these industries. Supply interruptions are not. As Thompson notes, a failure to secure silver does not raise costs incrementally. It halts production entirely. At the same time, mine supply is failing to keep pace with demand. Thompson estimates global mine production for 2025 at approximately 985 million ounces, while total demand is projected to exceed 1.1 billion ounces. That shortfall of more than 100 million ounces must be met through above-ground inventories, primarily held in exchange-traded funds. While these inventories exist, Thompson is careful to stress that they are not freely available supply. ETF holders will only sell at prices they consider acceptable, which introduces a price-dependent release mechanism rather than a guaranteed backstop. Against this backdrop, Thompson issues a nuanced warning to silver stackers and investors. While the structural picture remains tight, short-term price action could still move sharply in either direction, particularly if margin requirements are raised. A sudden increase in margins may force some long positions to liquidate, potentially creating a brief pullback even in a fundamentally constrained market. Thompson cautions that such a move, if it occurs on Monday, December 30th, should be understood not as a collapse in demand, but as a mechanical response to leverage stress. For disciplined investors, that distinction matters. Before we wrap up, we want to sincerely thank you for spending your time with us throughout 2025. Your attention, engagement, and willingness to think deeply about markets like silver and the broader financial system are what make this channel possible. As we move through the holiday season and into the new year, we wish you clarity, good health, and steady decision-making in both life and investing. If you found value in today's analysis, please like the video, subscribe to the channel, and share it with others who take these markets seriously. Thank you for watching, and we look forward to continuing the conversation with you in the year ahead.